After years of mega cap dominance, the tech trade has run into some turbulence and investors are widening the lens. Small and mid cap stocks are starting to draw fresh attention. Joining us now for an ETF Spotlight to discuss is Randy Gwirtzman, portfolio manager at Barron Capital. Randy, thanks so much for joining us.
Thanks for doing this, Caroline.
I really appreciate you being here. So, Randy, there's been a lot of talk about the rotation that we've been seeing out of mega cap tech. We're seeing money go into other sectors like energy and materials and staples, but also into small and mid-sized companies. What's driving that shift?
It's really interesting. There's, I would say, three factors that are kind of driving this right now. The first is there's an underallocation to small and mid cap stocks right now. As my analytics group kind of pulled up, if you look at the overall allocation of SMID to the overall Russell 3000, it's about 3% allocated now to that total equity group. Typically, it's 7.5%, so clearly underallocated. The second is, the valuations are pretty reasonable on a forward basis. Small and mid cap stocks, that index, the Russell 2500 growth, is trading at about 21.5 times, which is about a half turn below the S&P 500. And the S&P 500 typically trades in kind of a 15 to 17 multiple range over the last 20 years. Now, we know we have some fast growers within that segment, but it's above its range. Whereas for the 21.5 for the SMID group, typically that's more of a 20 to 22 range. So we're kind of right in range on an absolute basis. And then the last thing I would say is people are realizing that you're getting better growth maybe from smaller stocks than you are from the larger stocks. So as concerns of overall growth across the entire large cap universe kind of fade into the market a little bit, you're seeing kind of interesting situations. So like the SMID cap index on a forward sales basis is growing about 16%. For the S&P 500, it's about 11% for next year's sales. And we're 20% for the Barron SMID ETF, which is BCSM. So, we're faster growth. We've got good valuation, and the area of the market is pretty underallocated. And all this stuff with a good economic environment where we're kind of seeing inflation go below or, kind of at and heading down the 3% level and potential, exponential growth in GDP. We're kind of moving up to 5%. By some forecasts, it's a pretty good environment for small cap stocks.
Does the economic environment need to remain strong or resilient for this shift to continue? And I guess even broader than that, do you think this signals a broader shift, or is it a short-term reset after years of large cap dominance and maybe some value hunting now?
Yeah, I think other than some cross currents, which we can get to in terms of technology and things like that, I think it's a pretty typical economic situation to see smaller caps outperform as the rate cycle moves from higher rates towards lower rates, particularly in an economy where we're seeing good growth with low inflation. Now, there's a lot of underlying factors behind that, but we're seeing increased productivity kind of keep labor wage push inflation down. And the tariffs really haven't had too much of an impact, which is good. So I think it's a pretty good environment, and it will continue that way, barring some external macro shock.
Do you expect it to continue at the expense of mega cap tech, though? Because it seems like the money is coming out of tech and going into some of these other areas. At what point do you think that stabilizes, or will it continue to be at the expense?
Yeah, you're seeing much more particular investment in parts of IT, and it's the hardware and the semiconductor side of the ledger that is benefiting at the expense of the software side of the ledger. So data center build out, particularly for AI, has gone up enormously. We had a $200 billion capex spend roughly in 2024. That went to $400 billion for AI data centers in 2025. This year, they're expecting 650 billion or even more. You're seeing companies spend 150 to 200 billion each for these mega cap providers. So that's benefited semi-cap companies like Coherent, which we own in BCSM, which provides optical networking. On the other side, software is really getting hurt. You're seeing software down 20% on average year to date. Over the last year, small cap software is down 40%. And that is because AI, while it's benefiting the hardware guys, you're seeing, you saw it in Microsoft's earnings. The software side of the business is a big concern because people believe that AI can displace enterprise software and seat-based business models. um, Software now is trading at multiples that are as low as the 2015 break that we saw. Smaller, kind of lower growth companies under 15% are trading at 3.5 times forward sales. That's below 2015. We're seeing 20 to 25% growers trading at, kind of 6 times, 5 to 6 times sales, which is it's very low for that group. And we have great companies that we don't think will be displaced. Companies that do, for example, observability. Companies like Datadog and Dynatrace.
Mm.
This monitors network traffic and application performance. So large airlines use it to make sure that their systems are online and not losing reservations, or if something goes wrong, they can fix it quickly on an automated basis. These companies actually use their own AI, and they're not going to get displaced because they're so embedded into the network infrastructure of these enterprises, which is very complicated. Dynatrace is trading at only 13 times free cash flow, and it's growing free cash flow in the high teens. So there's some real bargains out there. The baby's kind of being thrown out with the bathwater right now,
Mm-hmm.
but we're pretty excited to own the companies that we think will be the winners at bargain prices.
Yeah, it's funny. Datadog up big today after earnings. So you mentioned that one in particular. I see that's a holding as well. Uh, so in terms of themes or particular areas poised to outperform in the small and mid cap space, it sounds like AI is still really the common thread here.
Yeah, I mean, so AI, I mentioned the hardware side of it and the software side of it. There's also AI that's being applied to, kind of companies that use atoms and electrons. And, this is kind of a phrase I heard that I really liked. But companies like Axon, so Axon makes tasers and body cams that are used by law enforcement. They also have software that backs it all up. So all that video gets backed up into their cloud-based software, and then AI can analyze that software and help law enforcement officers write up reports and maintain a chain of evidence for prosecutors and defense attorneys. Um, that can't be replicated by agentic-based AI models because you need the physical atoms, right? The sensors themselves that generate the data. So we really like that one. Um, and so that's some of what's going on in AI. But we don't believe that, for the most part, agentic AI is going to take over every software company. But there will be software
Mm-hmm.
companies that are disintermediated, particularly companies that have high seat-based models in areas where the AI itself can do some of the tasks of people who used to be the workers, like code generation. If you have a software company that is seat based on code generation, that's going to be pretty tough because existing software engineers can do the work maybe of two or three engineers now. Legal software could be at risk. We're kind of seeing that in the market as well. So we're picking our spots, but we are getting really excited about some of the things going on in AI.
Are there other areas where you get exposure outside of tech through the Barron's Midcap ETF?
Absolutely. So healthcare is a big area that we're invested in. AI is used in healthcare as well. So we own a company called Tempus AI. Tempus is a cancer diagnostics company. So they take blood samples and tissue samples, and they run high-end DNA sequencing on them and look for genetic abnormalities. They then give test results, obviously, to oncologists who are testing patients on that. But on top of that, they take all that data that's generated. They have a huge database of data, and they use their own AI to analyze the data and find kind of interesting patterns. But they're also connected, and this is part of the competitive differentiation of the company. They're connected to oncologists and academic medical centers all around the country who can go back and forth with them and see patient outcomes and relay their own cancer findings of patients who have similar genetic abnormalities. And in that way, they can then see that which data is most important for drug development. And then they take all that and then they sell it to the largest drug companies in the world because they have this sort of unique database, not only with the genetic data, but also with the outcomes-based data on the drugs that were used to treat the patients. So really exciting stuff. We're also invested in other companies that are kind of riding the biologics trends. So GLP-1s, obviously, the weight loss drugs
Hmm.
are really huge. We own a company called Repligen, which makes equipment that manufactures biologic drugs. And we also own a company called Stevanato, which makes glass tubing, which is used for vials, but more importantly for the cartridges that go inside the auto injectors that a lot of people use for their drugs, whether it's the GLP-1s or PCSK9s, which are used for lowering cholesterol and that sort of thing. So there's a lot of other areas that are really interesting to invest in right now.
Yeah, very interesting picks there and ways to play some of the broader themes that we've been talking about every day that aren't necessarily just the big names that we've been talking about. But it seems like it could be harder to stock pick through all of these companies that investors might not be as familiar with. So obviously they can get exposure through your ETF, but what
Yes.
should investors be careful about or avoid when it comes to small and mid cap companies?
Yeah. I mean, listen, I tell my friends, and I kind of selling myself a little bit here, but we do a lot of work. So Barron Capital is fundamentally based, and we have a long-term horizon that we're focused on. It's really hard to guess what's going to happen day to day in the market, or even, over a 1 year time frame. We think we add value by kind of looking over a 3 to 5 year time frame. We're trying to find stocks that will double over that 3 to 5 year time frame. And so the stocks that I've mentioned have free cash flow that we think will double or even triple over that time frame. And if you get it at a similar multiple to what it's trading now, obviously the stock would double over that time. With some of these software stocks, you can get a double in the free cash flow growth on top of multiple expansion, and that's how you make really, really big money. Um,
Hmm.
but again, it's all about deep fundamental research, understanding the companies, interviewing management teams, experts in the industry, competitors, and putting that all together and understanding strategically where these companies can go over time and what their competitive advantages are and how good the management teams are. And that's really what we do day to day and what we're focused on.
Okay, so because you said it's hard to predict where the market's going to go, even over the next year, of course, I'm going to ask you, but we have to make this one quick. If small and mid caps continue to be where the money flows, what does that mean for the direction of the overall market?
It's interesting. I think it's healthy to have a more broadening of the market as opposed to such extreme concentration in a handful of large cap stocks. So I think overall that bodes well for the overall economy. Kind of hoping the consumer can benefit from some of the tax rebates that they should be getting over the next month. And 2/3 of the economy obviously is consumer based. So we have consumer stocks as well in the fund, and we think that the broadening out of economic benefit really should be good for the stock market as a whole, all the way through the caps. But again, talking my own book, but we do favor the smaller stocks as they've been really ignored over
Yeah.
the past few years, and we've had sort of extreme valuation disconnects historically between this cohort of stocks and larger cap stocks.
All right. Well, we appreciate you shedding some light on the mid cap space. Randy Gwirtzman, portfolio manager at Barron Capital. Thank you so much.
Thank you very much for the time.